Welcome to College Smart Radio, helping you bring into focus the true cost of college and how to tackle the runaway costs of financing a college education. College Smart Radio is hosted by Beatrice Schultz, a certified financial planner and co-founder of Westface College Planning. Now, here's your host for College Smart Radio, Beatrice Schultz.
Most parents with students in college are familiar with the American Opportunity Tax Credit, the Lifetime Learning Credit, tax deductions on tuition, and tax deductibility of student loan interest. But few high school parents have ever heard of base year tax planning. Today on College Smart Radio, you're going to find out what base year tax planning is all about and the tax strategies you should be implementing a full 2 years before your student starts college to maximize your financial aid eligibility and pay less for college. Hi, I'm Beatrice Schultz. Welcome to our weekly show, College Smart Radio, where we help you tackle the runaway costs of a college education. Our show is all about bringing up-to-date and practical advice to parents who are dealing with the cost of a college education for their kids. With a private school costing up to $60,000 a year, a UC costing close to $35,000, and a California State University running $25,000, parents need more help than ever. We bring you that help by sharing ways to pay less, tapping into financial aid, and prioritizing your source of funds to make sure you get through the most expensive years of your life. Based on my own education and experience, I share my insights with you week in and week out. I hold a Bachelor of Science degree in Chemical Engineering and a Master's degree in International Business. I'm a certified financial planner and the owner of the San Carlos-based college planning business, Westface College Planning. I host workshops on college planning and consult with parents on a daily basis. In addition to my insights, I bring in experts in many areas of the college process, from counselors, financial aid officers, college administrators, financial professionals, student coaches, parents, and even students. You'll learn firsthand the ins and outs of how to pay for college and survive financially. In addition to our show, you can find lots of powerful information at our website, www.collegesmartradio.com. We have many articles that I've authored with up-to-date information on navigating the waters of paying for the runaway cost of college. We have a monthly e-newsletter full of content about college planning. We also have posted a glossary of key terms used in the world of college planning, terms like total cost of attendance, FAFSA, student assets, base year, which you're going to hear about today, and so forth. And we have a link to our free community parent workshops that we host to teach parents how to pay for college and how the financial aid system really works. So let's get into today's show. When parents think about tax planning for college, they're thinking of educational tax credits and tax deductions, which you will claim on your tax return during the years that your kids are already students in college. Those may include the American Opportunity Tax Credit, the Lifetime Learning Credit, 529s, tax deductions on tuition, tax deductibility on student loan interest. These are important tax planning concepts, but we're going to save them for a separate show. In today's College Smart Radio show, you are going to find out what base year tax planning is all about and the tax strategies that you should be implementing a full 2 years before your student starts college to maximize your financial aid eligibility and pay less for college. Base year planning involves keeping certain income and deduction items off the tax return in the base year in order to increase financial aid eligibility. Our guest today is going to share with us how that works. Jodi Eramo is a certified public accountant with over 10 years' experience in the financial services industry. She has an accounting degree from The Ohio State University and a diverse professional background that includes public accounting, small business consulting, tax preparation and planning, financial planning, and also federal employee benefits consulting. Today, a large part of her practice is in tax advantage college planning for small business owners. Jodi has 4 children, and her eldest just started college this fall, so she also has personal experience in putting a college funding plan together for her own daughter. Jodi is currently a college funding specialist and in-house CPA at College Planning Relief. Hi, Jodi. Welcome to College Smart Radio.
Hi, Beatrice. Thanks for having me today. I'm delighted to be here.
Jodi, perhaps we can start the show by telling our audience a little bit about College Planning Relief, or CPR.
Oh, yeah, absolutely. College Planning Relief is a national organization. Really, our purpose is to educate parents on how to pay for college without jeopardizing their own financial futures. You know, as you said, Beatrice, the cost of college is increasing at an alarming rate. There's the student debt situation. Student debt has for the first time ever surpassed credit card debt. So we feel that people are really going about the paying for college process in the wrong way. And so our purpose is to educate them on the smart way to go about it.
I was introduced to College Planning Relief at a conference of financial advisors maybe 3 or 4 years ago. In fact, they were the catalyst for us to expand our Westface financial planning practice and start my Westface college planning business. Jodi and her colleagues have been a great source of college funding expertise for me, and I'm thrilled to have her on College Smart Radio. Jodi, I introduced the term base year planning. Let's start by explaining, what is base year?
Well, base year is, it can be kind of confusing because base year is a full calendar tax year that begins in January of a student's junior year in high school and runs to December of their senior year. So it sort of straddles that academic year. So, for example, for right now, for current high school seniors, 2012 is their base year. It would have started this past January when they were still juniors, and it will go to this December of their senior year.
So when parents are thinking about this, really base year planning, they should be thinking about it before their junior year, or before the junior year is starting, or definitely in the beginning of the junior year for their student who's going to be going to college in 2 years.
Absolutely, because basically, base year planning, what we're doing is we're trying to keep income and itemized deductions off of that base year tax return. So when we're thinking about January of their junior year, we're trying to, be ahead of the game and do things, perhaps in the beginning of their junior year to concentrate income items into those months rather than, keep them out of January, February, and so in the base year. So you want to do things ahead of time. And then for the second half of your senior year, it's almost the opposite. Things that you maybe would have considered doing that will affect your income and or itemized deductions, in November, December, if you can wait until after the base year.
Okay, so just so people understand kind of why we care about the base year, colleges, when they are offering financial aid awards to seniors, they're going to take a look at they're going to look at that base year. So for seniors today, it would be their 2012 income year and what their assets would be as of January of 2013. And that is the financial information that they use to offer a financial aid to the colleges. Is that how you would describe it?
That is exactly how I would describe it. So right at the conclusion of the base year, again, that would be this December 31st, 2012 for current seniors. Immediately in January, they're going to be filing their FAFSA, which is the free application for federal student aid. That information is submitted to the U.S. Department of Education, and that is the start of the process whereby they're going to determine how much money your family can afford to put towards college every year. And on that FAFSA, you're going to be reporting income information from your 2012 tax return. Again, that's going to be the base year, so it's hugely important, that we make that number be as low as it can possibly be in that year.
Okay, but before we get into the details, let's discuss a little bit about who should be doing base year planning. And I talk about one of the first steps in your family's college planning process is to evaluate whether you may qualify for financial aid for college. Many colleges have generous endowment funds, so more families qualify for some of that money than most families would think. And I really recommend that every family attend one of my workshops as a first step to know whether you may qualify for financial aid. But if there's any chance your child may qualify for any financial aid at any college, then you need to do base year tax planning, and you want to do it early. Okay, Jodi, let's talk about what base year tax planning is about.
In base year planning, is we're basically doing tax planning, but our purpose is not to pay less on our taxes, it's to pay less for college. So, for example, if Dad typically gets a bonus in December, say his student is a senior right now, he's going to ask his employer to perhaps delay that bonus until January so that that bonus will not be reported on his 2012, his base year W-2. So, to your point, anybody who thinks that they are going to qualify for financial aid, typically we put these families into either Category 1, Category 2, or Category 3. Category 1, meaning they likely will qualify for financial aid. Category 2, meaning they may or may not, depending on where they're looking. Category 3, meaning they absolutely will not qualify for financial aid, being that either their income and or their assets are too high. So anybody that thinks that they might qualify for financial aid, base year planning is going to be an excellent strategy for them to employ to hopefully help them pay a little bit less.
Okay, so the first thing is if they're juniors, they want to, in their junior year, the year before their base year, they want to pull the income into the year before their base year. If they get a bonus, and they could pull it in December. On the other side of it, if they're seniors, it's already in 2012, they want to push that bonus out to January of 2013.
That's exactly right.
Okay. Hey, Jodi, we're going to take a break here, but and we're going to be back in a minute, but let me just interrupt you for a quick break. You're with us on College Smart Radio with my guest today, Jodi Eramo, a CPA with College Planning Relief. Jodi's sharing with us the exciting ways that tax planning in your student's junior year can make a huge difference in financial aid eligibility. We all know that college is expensive and will most likely be some of the most costly years of a family. And understanding how to navigate the financial aid system is a really smart thing to do. To help families beyond this radio show, I host community workshops at our West Face College Planning facility several times a month that explain the costs of various college, how the financial aid system works, and things to consider to prepare yourself for this tremendous expense. You can find my workshop schedule at collegesmartradio.com. We'll be right back with Jodi Eramo on College Smart Radio.
For more information on today's topic, visit collegesmartradio.com or call area code 650-587-1517. College Smart Radio continues in moments on AM 1220 KDOW. Contact Beatrice Schultz at collegesmartradio.com or call area code 650-587-1517. Now, back to College Smart Radio with your host Beatrice Schultz on AM 1220 KDOW.
Welcome back to College Smart Radio, where we help you tackle the runaway costs of college. I'm Beatrice Schultz. I'm talking with Jodi Eramo about tax strategies to implement while your kids are still in high school to maximize your family's financial aid eligibility and thus pay less for college. Jodi, let's remind our audience of what the base year is and why it's important for their financial planning.
Absolutely. Base year runs from a student's junior year January of a student's junior year in high school through December of their senior year. It's important because the income reported on your tax return in that year is going to be the starting point for determining whether or not your family is going to qualify for financial aid.
Okay, so what's the concept of base year planning?
Well, it's mostly a timing issue. Like, for example, if Dad typically gets a bonus every year, we're not suggesting that he go to his employer and say, hey, no thanks, I don't want one this year. I'm trying to report a low income on my tax return. Nothing like that. We're just trying to change the timing of income so that it's not reported in the base year. And really, Beatrice, it's a two-step process. Once we've minimized the income on the front page of our tax return, then what we want to turn around and do, it kind of seems counterintuitive, but it actually works, believe it or not. Once we've minimized the income, then we want to maximize the tax that we pay on that income. Number one, the reason we want to do that is because, AGI is reported on that FAFSA as the starting point. The total tax that you pay in your base year is subtracted from that number in that calculation. So we want that number to be as